and welcome to the number one finance podcast in the world, where we discuss risk-adjusted returns on a risk-adjusted basis, leveraging the highest risk management tools available to man.
Or we just talk about, what's the latest tech deal that's happened, and then get gassed about it because half of these men don't even know what they're doing.
Risk management and financial engineering. I don't know. I'm just.
It's quite cool. It's cool. They call it financial engineering. Financial engineering doesn't actually.
I studied financial engineering, and it's bullshit.
What is it?
All finance degrees are bullshit. If it's not STEM, go home. Go STEM or go home. I mean, we both did not study true STEM, and we agree that if you are going to college, university, please study STEM or do not go to university. Free plug, actually. I mean, I'm not sponsored by him, but anyone planning to go to college, read Aaron Clarey's Worthless book. It's the indispensable guide to I forgot what it's called. He always picks these really long titles. It's basically titled something around not majoring in worthless crap. So that'll save you a whole lifetime. We have strong opinions, loosely held. If you're new, welcome. We discuss what's going on, but discussing the overall concepts behind what's going on from a first principles and Lindy standpoint, without really overcomplicating things, calling people out on their BS. Please call us out on any BS as well. We're always open to being educated and changing our minds.
Spam Cyrus.
Even though we have more experience than pretty much most finance pods in the actual finance industry, yet we seem to be the ones who say we don't actually have all the answers because no one can predict the market. Anyway, what do you have for us? What's the first topic of the day?
CB Insights. The old Crunchbase Insights has posted something quite useful. They've made a list of all the unicorns worldwide, and there are 701 unicorns worldwide. What do you think their combined value is?
No idea. Something astronomical, and I assume it's rocketed in the past year.
Oh yeah, 100%. It's $2.25 trillion. Like, that's more than fucking. I can't. It just blows your mind. It's huge. Where do the? I think you're going to know the answer to this. Where do the majority of these unicorns come from?
US and China. I don't even have to think about it. I bet maybe 1% come from Europe.
I think it's a little bit more than that. It's like 5% is from Europe, but unicorns hail from 35 countries, with more than half or 52% from the US, and then China with 21%. They literally have a monopoly on new businesses, like new tech businesses in the market. So when people talk about Europe being behind or whatever it is, it's actually true because everything is basically in US and China. And then there's a crazy stat that popped out of the back of it that our good friend Michael Jackson posted. We'll pull up the post he did on LinkedIn. He says there were more unicorns created in the first 5 months of 2021 than in the 5-year period between 2014 to 2018. There was 187 unicorns made in 2021 so far, and there was 175 in the 5-year period 2014 to 2018. What the hell? How the hell does that happen?
I think it's pretty easy to understand. It's one of the main reasons. We've had this, people call it a bubble. They've been saying for the past decade, when is it going to pop? When is it going to pop? And what you had was investment going into tech companies as you would from 2014 to 2018. But then what happened is, and we've discussed this before, that people, number one, they caught the tech bug. Number two, the pandemic further fueled this because money print to go brr, low interest rates, typical stuff. We always mention this. It's just economics 101. You had more capital flowing around. Some people highly leveraged, using that to invest. Some people were just, as LPs, throwing more money at GPs to invest because people realized the returns that one can achieve investing in tech. And so what happened is a lot of those companies that had raised investment 2014 to 2018 then raised further rounds, maybe your series C, D, E, etc. in this past year, which then only then made them become sort of a unicorn status. Of course, there are exceptions. There are ones that have launched in the past couple of years, rocket ships that have suddenly become unicorns, but there's exceptions to every rule. And what we're actually discussing here is those that had raised investment. Yeah, they were large tech companies, but not unicorns. And the past year, the amount of capital flowing around really fueled this. And so I don't think a lot of...
So you're saying it's a function of inflated valuations, not a function of actual value of those businesses?
Correct. I was literally just about to say that before you said it for me. We've said this before. Most of these tech companies are bullshit. Most of them are absolute bullshit. I mean, look at fucking Uber. How many years? It's been operating for 10 plus years, still unprofitable. Growth stock. Growth strategy. Growth stock is 3 to 5 years, not 10 years. So, I mean, I don't want to give Uber a hard time. That's just one example. But yeah, most tech companies overvalue. I mean, that's what our brand's pretty much based on. Calling out if people go to rationalvc.com, the first ever article I published was tech markets are irrational, what to avoid. And I call out all of the companies and their BS low bottom line that is heavily in the negatives. So as they say, revenue is vanity, profit is sanity, what you can actually eat on. But unfortunately, this industry operates on he or she invested in this, therefore we must invest in this and mark it up even more. And the next person marks it up even more for some poor dimwit to pay the exit price and the rest get paid. But where's the real value creation? It's not in the right now. I don't see a lot of life sciences or deep tech. I see a lot of bullshit getting funding, heavily loss making, not profitable. And my hat goes off to the very few, such as Andrew Gazdecki and a few other entrepreneurs who actually bootstrap startups, or even if they do raise funding, fine, but they operate profitable startups. And fine, I understand some companies need to operate unprofitable for a period because they're investing for growth, but there's a limit, and a lot of companies are forever unprofitable. I mean, we've seen exits of companies where they have 3, 4, 5 months of runway left and they get acquired. And most acquisitions are bullshit because firstly they're acqui-hires. I want to discuss him a bit later on, but Antonio Garcia Martinez, AGM, the author of Chaos Monkeys, as he said in a wonderful presentation, which we'll try and find a link in the show notes, he said he got acqui-hired, and he even says pretty much all acqui-hires in Silicon Valley are bullshit. It's just a way for the companies to acquire the engineers. They're not really interested in the tech of what they're acquiring. They just want to get a bunch of talented engineers to join their team who have specialism in a certain field. So gone on a tangent, but I've called on a few different bits of how the industry's bullshit. Hat goes off to the very few who are doing it the right way, and long may this continue.
I didn't realize you were going to go into some 10-minute rant onto what's wrong with the industry. But also the list is I think incorrect actually. Now I'm scrolling through it, some of the UK ones aren't there. You know, you've got Octopus Energy that was valued at 2.2 billion that's not on the list. They've included OVO, but OVO I don't know why that's on the list. But anyway, point is there is interesting ones on the list that I don't know if all are accurate. Also, what do you think is the highest valued on that list?
Are we talking private companies? In private companies, I think it's Stripe.
Unicorn. Stripe, not a bad shout. They're number 2. Number one Ooh. Blows them out of the water, and that's ByteDance. China's ByteDance that's valued at $140 billion US. More than SpaceX. SpaceX is at 74. Fucking nuts, man. All right, what's next?
Next is... You sent this to me, something we've pulled up. I think, was this again from Michael Jackson? I think it was from Michael Jackson.
Yeah,
but
man,
he essentially...
Probably is.
I mean, it's very telling that you're discussing the article on CB Insights and you're saying it doesn't have they've missed out some of the unicorns. There's journalism for you, but then you have someone like Michael Jackson, independent on LinkedIn, just publishing stuff, and we refer to him more than we refer to journalists, so that's something. Anyway, I was getting ready to throw up a Nassim Taleb quote about journalists, but I think I've been ripping into people enough for this first few minutes, so let's just get on to the content. Why VC is highly risk averse. It was a podcast, so there's a link. We'll throw this in the show notes too. I think Michael Jackson said this regarding that podcast. He said, venture capitalists love to cultivate an image of themselves as risk-taking cowboys with a nose for great ideas and the ability to help book-smart inventors and programmers grow into savvy entrepreneurs. But in reality, the industry has spent a quarter century chasing Google-sized returns in the relatively safe, efficient, and low-cost markets, such as consumer and enterprise software, mobile apps, and, to some extent, healthcare and drug development. Sure, smartphones and apps are fun, but how much is the next new video sharing app or gaming platform going to contribute to human welfare? Couldn't have put it any better myself.
Look, what he's saying is basically... We've passed that point where venture is funding things that are not necessarily important to society. They've funded a lot of consumer tech. I don't want to point fingers, but you could look at some of these social media apps potentially that are not really that value adding, but that are getting massive valuations and massive funding behind them. Actually, now that you get into this tough tech environment where you want to solve the world's hardest problems, be it extraterrestrial or be it with climate or whatever it is, you're going to need real investment and real time-based investment. What does that mean? You need to put a shit ton of money into something over a longer period of time to see actual output. So you're not investing to get a markup a year or two down the line and exit. What you're investing in is to actually change, to create technological change that really moves humanity forward. Venture is not necessarily primed for that. That podcast was really interesting because they spoke with, I think, the managing partner of The Engine. The Engine is MIT's essentially venture lab. They talk about this type of tough tech as being things that you need to really get behind over a long period of time, with a view that although the majority is going to fail, you're doing something that's supporting humanity's growth forward, which is very different from what we see in a lot of the venture capital firms today. Maybe that's what venture started out in the first place. Today it just seems like a smash and grab of who can get the highest valuation and exit on a massive multiple. It is what it is.
We've covered this enough. What's really going to move we've discussed the O'Reilly article, is this the end of Silicon Valley as we know it? That sums up pretty much and what Michael Jackson has said here. Let's touch on very quickly on this topic, Clubhouse. How long has it been since you last opened Clubhouse?
Genuinely not. Like the first 2 months we had it, we were going hard on it, and now I just don't, nothing. I haven't even opened it.
All those absolute fools who are spending 18 hours a day building brand following, and now look, no one's on it. I mean, you've got a few frauds on it. You've got people like, I don't know, the Tony Robbins type who are snake oil salesmen on there, but you don't have any real intellectuals. You had them coming on initially when there was a bit of hype and buzz, and look, fickle, B2C. Andreessen Horowitz got very upset and they block anyone who criticizes that investment. I think Sean Puri of My First Million had this fantastic Twitter thread where they did an episode on this back in March where they ripped into Clubhouse. We'll link this too. Very logical. He has experience in that field of why he thought it was going to fail, and too soon to say. We've got to give it a 12-month time span at least, but it looks like, based on the numbers, sign up volume, usage hours, etc., which are all down from what I've seen, it looks like it is going to fail, and they should have taken the Twitter acquisition for $4 billion. B2C is fickle. Work on real hard problems, deep tech, life sciences, climate change. I'm getting tired of this. I mean, how many times do I have to say, shout out Navar Ravikant, hard decisions, easy life, easy decisions, hard life. Spend 10 years, head down, tough problems, as Cal Newport says, rare and valuable skills, develop mastery, shout out to Robert Greene, and 10 plus years, you'll achieve something. But if you want to go for the quick hit results, as most do, are always chasing the next B2C thing. One thing fails, they're on to the next one. And yes, we know that I'm an advocate of this whole fail to learn notion, but that's not what I'm discussing here. I'm talking FOMO, groupthink, stupidity, no logic or rationality, no critical thinking when deciding what to build or what to work on, but time after time after time just chasing the next hot thing. So 1 month it's some crypto bullshit, some ICO back in 2017. Then it's just always a new craze. So entrepreneurs need to be tackling more pressing things. And I think that's enough on that. What's next?
Next is a post by The Economist. The Economist has posted something about why Europe is so dangerous when it comes to the shifting world of regulation. Europe's now, as they call it, a corporate also-ran, i.e. can it recover from its footing? Essentially what the article's saying is that over the last 50 years, I think, Europe's only created 2 companies that have been valued at more than 100 billion, SAP and ASML. So what you're essentially seeing is not only is China and the US, as we spoke about earlier in the episode, taken over with loads of high value companies, it seems that Europe's taking a downward trajectory in that regard as well. And a lot of those issues, as our good friend Michael Jackson says, is that they're self-inflicted. What that's led to is not just a reduction in the amount of tech companies that are coming out of Europe, but also the value of corporates, right? Not just new age 5 to 10 year companies. We're talking companies that are 60, over 100, 150, whatever, however many years old, that are failing to invest in R&D, that are failing to to take on the competition. And it also explains why a lot of US companies are starting to enter Europe with rose-tinted glasses, realizing, okay, yes, the market might be messed up in Europe and there might be too much regulation, but actually all these companies are woefully prepared to deal with someone like us. So it doesn't bode well, is basically the article's overarching message.
Are you surprised?
I sway back and forth on Europe. We had that episode with Sean Seaton Rogers where he spoke really highly of what the potential for Europe could be. But then again, like when you're just getting constrained year after year by regulatory pressures, like this new tax deal that came in, it's apparently world-changing tax deal where you're just going to tax the tech companies more money. Makes sense because they're basically paying their tax to the Irish haven. But you want to spur innovation, you don't want to hinder it. So I don't know.
So anyone that wants to listen to it, Sean Seaton Rogers, go back a few episodes. We did a podcast with him. He is ex-Benchmark, big VC, now runs his own VC firm in London, has done for the past decade. He's very bullish on Europe, but I said to him, and I've always said, I am not bullish on Europe. This is what happens. I mean, you look at the top, we've looked at the top 30 companies by market cap globally. You discuss even the unicorns in the tech sector. Whatever you look at, it's dominated by US and then China. Long may this continue for US. They deserve it. This is what happens when you have a free market such as the US that is pro-capitalism. And to the critics of capitalism who, yes, we acknowledge, us capitalists acknowledge it's not perfect, but it is the best solution. So much for Adam Smith's Wealth of Nations and Matt Ridley's Rational Optimist and many other great books on such topics which people should pick up. Europe should learn from these basic principles. What you've said in this Economist article around Europe corporates, I see it getting even worse. This is what socialism does. And on top of that, it's just a mindset thing. Yes. I'm biased. I'm more pro-US than anyone, as everyone knows. Best country on the planet. It has its faults too, as does anything. Everything in the world has pros and cons. But overall, I think US is the best free market out there.
Well, look, next on the list, let's actually talk about companies that are doing well in Europe. We've recently had Babylon Health release a statement. Ali Parsa has released a statement that Babylon Health is entering a SPAC and it's going to go public. Do you want to touch on this?
Yes, I'll open up his post. What did he say? Let me find.
He posted a
screenshot. Beautiful. And look, people will say to me, "But hey, you've criticized SPACs before." And yes, I have. I'm usually anti-SPACs. I did say on an earlier episode that Alex Chesterman taking Kazoo public in the US via SPAC is a great move for them. In some cases, some SPACs are very good because the company or the management team of the company, plus various other factors and unit economics and business model and so on and so forth, are all very good. Most SPACs are bullshit, but the very few that are good, I'm very happy about. But this SPAC, I am more happy about than any other SPAC in history because I'm biased. I am fucking biased. You damn bet I am. Because Ali Parsa, very quick background, anyone that doesn't know, he is an Iranian immigrant, came to the UK at the age of 16 alone, and he did not know how to speak any English. He locked himself in a room for 2 years and self-studied and self-taught himself. He self-studied A-levels, which are the qualifications needed to get into university. But how can you self-study A-levels if you don't know how to speak the language? At the same time, he had to teach himself the language of English. He managed to get into UCL, one of the top 5 universities in the UK, did engineering, as does any smart person in the world. Stayed there for undergrad, master's, PhD. Then he worked in investment banking for 6 to 8 years. Goldman, maybe? I don't know. I don't know which bank. At a couple of banks. And then, like any other wise person, said investment banking is bullshit. I'm assuming this is what he said. And he launched Circle, which was a health tech platform in the early mid-noughties. I don't know the specifics, but I read somewhere he got screwed over in that by the VCs that had invested. And so he basically left the company that he built with pretty much nothing to own. He really got screwed over. Most people would sit there crying and dwelling. He said, fuck this, I'm going to launch another health tech company that's even better. Launched Babylon Health, which is what we're discussing now. And I know, and you know, we have friends who have worked there or work there, who have pretty much, some of them were part of the early team of Babylon, who helped launch it. Some have left, but some are still there. But the company is predominantly all the different management teams within different departments, they're all immigrants. There is a large number of Iranian immigrants in this company, and it's the first really tech company I'm aware of in the UK ran by Iranian immigrants that has gone unicorn status and now such a household name. So I am more biased than anyone. So many Iranian immigrants are going to eat off this deal, and I hope they eat so much and their houses and their pockets just explodes with excessive cash that they then use to fuel further innovation and angel investments and their own projects. And I'm very happy. Loads of Iranian immigrants having FU money doesn't get any better than that. So yeah, that's my bit.
Fair enough. I don't disagree with you. But I think on the point that you said that, you think this is a good SPAC, I agree. Why? Because they're SPACing through Al-Khoury Global Acquisition. The shell company is Al-Khoury Global Acquisition, and it's led by someone that's actually got clout and knows what they're doing, Rich Williams, who is the former Groupon CEO. And they're valuing at a pro forma equity value of $4.2 billion. So pro forma equity value. Essentially, it's a liability removal calculation. So you're just saying anything that's debt focused, we remove from the valuation. Yeah, it's going to trade under the ticker BBLN. Sounds cool enough. But yeah, it looks like it's going to be a good deal. It looks like it's going to cement Ali Parsa's position on the Sunday Times rich list of the wealthiest people in the UK. Is currently within the top 250 with an £825 million
I hope
worth.
he reaches number one.
We'll see.
And I hope the other 249 Iranians in Babylon Health reach the top 250. And look, people were like, oh, but you're biased. Yeah, you're just very biased. For you to be aware of why I have this view, you'd have to be an ethnic minority immigrant being raised in the UK. The difficulty and challenges that these people have overcome. Like when I won't go into it in detail, but for example, one example of hundreds. When I was trying to get into the corporate world years ago after graduating, you remember, I applied with a traditional Persian king name and...
Persian king name.
Multiple rejections and the same CV, the same resume, nothing changed. The only thing that changed was an anglicized name. Got multiple interviews, multiple offers. That's just one tiny example of the bullshit that we have to put up with. So kudos. I hope they not only become top 250 in the UK, top 250 in the fucking world. Let's go. And I think Palantir invested in Babylon as well. So yeah. What do you know about this? Was Peter Thiel at the wheel, or was it just generally Palantir's management? We don't have the details. I don't think we have those.
Well, I don't think we have the details, but the guy who's been quoted as releasing all this information is Kevin Kawasaki, Palantir's head of business development. And what he's seeing is, he's saying, we're seeing an opportunity to back really good management teams with big visions. What's he referring to? In the last 3 months, Palantir has forged agreements to invest in at least 6 SPACs. Palantir is becoming a bloody investor themselves. And you've got to think, yes, Mr. Thiel has to be behind this in some way or another. He's spreading his wings through multiple different vehicles, and one of them is the company Palantir. They're investing $230 million into the Babylon Health SPAC, which bodes well. Why? It bodes well because, one, you've got a big brand name going behind you. When you're Babylon, you've got Palantir behind you, which is great. 2, it gives you synergy opportunities. It gives you the ability potentially for Palantir to enter discussions with Babylon if they're not already using some form of back-end system from Palantir, some sort of cloud integration with Palantir. And 3rd, it also gives clout through the names that are behind Palantir that are investing in Babylon. So all of this should compound to give some level of comfort to the markets that Babylon's going to be a good company to invest in, and hopefully help raise that price once it floats.
Beautiful. Next topic. So for anyone that knows Julian Robertson, the old man, the old quote-unquote legendary investor behind Tiger Management, he pretty much created all these Tiger Cubs who left Tiger Management and went on to launch some really big hitting names. So these people include, let me pull up the list. Who do we have here? Chase Coleman of Tiger Global. It's the first generation. Philippe Lafont of Co2. So Co2 and Tiger Global, pretty much the 2 giant tech investors right now. And then you have others such as Viking Global Investors, Discovery Global, Maverick Capital, Egerton Capital, Lone Pine Capital, a bunch of hedge funds. But one that you have is Bill Huang of Archegos Capital. I think I pronounced that correct. And what's interesting is, I mean, I made this post. This is where I called BS on most SPACs. I mean, me and you called this back in December on the SPACsmas special podcast we did, and Charlie Munger later said in his annual meeting, crazy speculation in enterprises not even found or picked out yet is a sign of an irritating bubble. And Buffett said, if you put a gun to my head and said you have to buy a big business in 2 years, I'd buy one, but it wouldn't be much of one because you only have 2 years to buy a business once you raise SPAC. Anyway, so what's happened is with Bill Huang of Archegos Capital, people can go and read it. I will link it in the show notes. It's been all over the news for the last I don't know, a few weeks, how he lost billions. I don't know what the figure was, 10 billion, 2 billion. He lost an obscene amount of money overnight.
It was more than $10 billion he lost.
I think it was 20 billion actually, right here somewhere. Anyway, we'll find out and put it down there. But banks across Wall Street have essentially become more wary of how much leverage they can extend to their clients following the collapse of Archegos. So it's forced hedge funds and family offices to reconsider their investment in SPAC. So this lack of leverage is really foiling the investment strategy of hedge funds that have played a big role in this SPAC boom by investing at an early stage and then not sticking around for long. So as I've said, spineless frauds with no skin in the game. These guys receive allocations of shares in SPACs before they're listed at $10 each, because that's the price that SPACs are typically listed at. And by using borrowed money leverage, the funds end up earning a juicier yield from the underlying asset, which many consider to be risk-free, quote unquote. But many hedge funds then sell out if there is a pop in the share price, or redeem their investment when the time comes for shareholders to cast their votes on an eventual merger with an operating company. Bill Hwang was in the middle of all this mess. He got caught out and he went bust. The reason we mentioned Julian Robertson of Tiger Management, he came out, there was a great FT article actually on all the Tiger Cubs that Julian Robertson has created from the original Tiger Management. But what's really funny is one part of the FT article where they interviewed Julian Robertson, he says, "Bill Hwang is a good friend and I know Bill well. I think he made a mistake and I expect that he's coming out of it and he'll go right on," the 88-year-old told the Financial Times in a rare interview. A couple of really funny comments. I really love the FT comments, because one of the finance bros came out and said, "Go right on, eh? The old man lost his marbles. The guy, Bill Hwang, pleaded guilty to wire fraud and now left major banks with billions in losses. But hey, just go on, bro. Forget about it." I mean, someone else said investment porn, glorifying an industry and people as rock stars, when the science is very clear that hedge funds have failed to consistently deliver above market returns. Imagine a surgeon or a pilot or someone in a field with skin in the game fucks up. What happens? Do you get a second shot? No.
You're in prison, mate.
But, you know, in the hedge fund world, Bill Hwang, with Julian Robertson's support, saying, "Hey, he should just go right on." So, yeah, this is why I say most SPACs are BS.
Philippe Lafon, who was the founder of Coatue, as you mentioned, who was one of the Tiger Cubs, he talks about Tiger's focus on hiring. And it's in the article, he says, people who are well-rounded instead of specialists with the special sauce. And what they tried to create was a culture of people who are competitive, curious, and extroverted. Any business that, number one, doesn't hire specialists, i.e. is not hiring technical people, you're going to be in trouble at some point down the line, because you're chatting shit. Like, you are chatting shit if you don't have specialist information. The second thing is, and by the way, you can hire that special information, you know, from a consultant perspective as well. It doesn't have to be in the business, but being so specific as to not hire technical people is a bit dangerous. And the second thing is an extroverted culture. There are multiple books written about introversion as being a really important part of building a business. And creating a situation, creating an environment, creating a company that is homogenous enough like this, that does not take into account heterogeneous talent, becomes a dangerous place to work, because you end up in a cycle, an echo chamber cycle, really, where people are just listening to each other, not learning from each other, and then you fall down these rabbit holes that this Hwang guy has fallen down.
I assume Philippe Lafon didn't read Chamath's thread on hiring, how to remove bias and box checking practices. Yeah, and this is what you have. And you hire a bunch of clones. They're all the same mentality, same upbringing, same mindset, same perspective in life and of the world, same worldview. No skin in the game whatsoever, awash with cash. And really, it becomes a game of pray and spray. And so people giving these guys big credit, doing all these in-depth Substack articles on these are the strategies that are being used by Coatue. It's like, there's no strategy being used. Just a bunch of bros that are washed with cash from LPs who... So that we've discussed this before. If you're new here, I'll break it down very quickly. The LPs have billions, and they say 5 to 10% of our portfolio is going towards speculative assets. That becomes tech VC investing. They throw at these hedge funds to allocate into VC tech. So the LPs don't care. They've already said this is money we're willing to lose to provide asymmetrical returns, because the rest of their portfolio is safe. So then this speculative portion of their portfolio goes to these GPs at these hedge funds, who also don't give a shit. because no skin in the game and awash with cash. And they know that when you have so much cash and you do spray and pray, dartboard analogy, of 100 investments, 1 or 2 will become unicorns anyway and it'll stick. And that's the nature of the game. And this is what, going back to the start of the episode, we talked about a lot of bullshit getting investment and overvalued, and not enough deep tech, life sciences, climate change getting investment because people don't want to work on tough problems. Is because the investors don't want to invest in tough problems. They want quick returns. So bullshit fuels bullshit. And full circle, we've come back around to what we started with. And I think it's a good way to start wrapping up.
Bullshit fuels bullshit. Basically, you bullshitting me fuels me bullshitting you, and then this bullshit cycle continues.
There you go.
Welcome to the bullshit podcast. All right.
And on that note of positivity and optimism,
stay rational, everybody.
Yeah, stay rational. Rationalvc.com. Subscribe to the Rational Letter, once a month, in-depth essay, memo, whatever you want to call it, fact-based, logical.
Facts.
We are not journalists. Facts on facts with X's. We are not journalists. There is no BS. And yeah, subscribe. Many subscribers. If you don't want to subscribe, read a free one. See if you like it. It's all on the website, rationalvc.com. Catch you on the next one. Peace.